I'm Francine Lacqua.
And I'm David Merritt.
This week on In the City, we speak with the wonderful Bloomberg Opinion columnist Javier Blas. He joins us from Sintra, Portugal, where he's been talking to central bank governors. And when I say talking, he's been briefing them about what energy and energy prices do next.
That's right. We're going to discuss the conversations that are happening on the ground between policymakers as they gather amid this worsening economic backdrop and, of course, most importantly, this increasingly complicated and baffling war between Russia and Ukraine.
Javier, thank you so much for joining us. It's not often that the policymakers here in Sintra get a briefing by Javier Blas. They don't get briefed by reporters very often. And this is after 3 days of really incredible events over the weekend in Russia, with the Wagner Group going in, then going out. We are still clueless about the kind of agreement that, Putin and Mr. Prigozhin actually signed on. But what can you tell us about what this all means for energy markets?
Well, the biggest implication at the moment is for oil markets. And the truth is, we don't really know what's going to happen because we don't know what's going to happen in the Kremlin, or more precisely, who is going to be in the Kremlin. But I can give you a summary of two opposing views right now on the market, and two opposing views that policymakers need to take into consideration, particularly for the oil market. One is that at some point over the next few days, weeks, Russia descends into a civil conflict. Different factions take different positions. The monopoly of power by Vladimir Putin gets completely curtailed, and others can wage war into the Kremlin. What happened with the oil fields? What happened with the oil pipelines? What happened with the oil export terminals? And the danger there is a civil war very much similar to what happened in Libya. Different warlords control different production streams. Perhaps oil production is stopped. Let's not forget that we have historical precedent, the Islamic Revolution in Iran with the fall of the Shah of Persia in 1979. That was preceded by a massive strike in the oil sector that basically brought production down in Iran from 5 to 6 million barrels a day to almost nothing. And that was about 10% of global market at that point, similar to what Russia represents today in the market. That is obviously extremely bullish.
10%, that is huge. I mean, what does that, if you take 10% of what's available in terms of oil production, where does the price go?
Well, the sky is the limit also because we sold a significant chunk of our strategic petroleum reserves last year to mitigate the impact of the war in Ukraine, the invasion of Ukraine by Russia. So we will have less of a cushion there. We will require other producing countries like Saudi Arabia, United Arab Emirates to compensate, but there is no spare capacity for 10 million barrels a day. Obviously, that is an extreme scenario that will be massively bullish for the oil market. And then it's not $100, it will be much higher than $100. The bearish scenario, completely opposite. What if Vladimir Putin gets deposed and someone replace him, which doesn't seem Russia as belonging to the OPEC Plus alliance? Let's not forget, this is not really institutional of Russia belonging to OPEC. This is less than 10 years. It started in 2016 on an agreement between Vladimir Putin personally and then Deputy Crown Prince of Saudi Arabia, Mohammed bin Salman, now the Crown Prince. That was happening in 2016 on the sidelines of a G20 summit in China. They got together. That was over the time, got reinforced a few years later. There was also a G20 summit, and probably many people still remember that kind of bro handshake, high fives between Vladimir Putin and Mohammed bin Salman. They got together. But it doesn't mean that Russia really needs to stay with OPEC. If that happens and Russia leaves OPEC Plus and it goes into try to maximize oil production, then we go back to an oil price war. The OPEC power gets weakened, and that is massively bearish oil price. We're going back to very low prices, certainly below $50 a barrel. So I can give you the two scenarios. I have to be honest, I don't know what's going to happen because this is all about the political intrigue in Russia. This is about what happened in the next hours, days, and weeks with the power of Vladimir Putin.
Javier, you've laid out the alternative scenarios there, and I guess that explains why we're not actually seeing, well, we're taping this on Tuesday, aren't we? We're not seeing at the moment a big move in oil prices. Is it because the oil market is as confused as, well, you're not confused, but as kind of undecided as to which way this is going to go? No one knows. It is just a very unpredictable situation right now.
I think that you are right, David. I think that the oil market right now, the way I will describe it is in a wait and see situation. The political events happening in Russia are beyond the predictive capability of anyone in the oil market. So everyone is waiting to see what happened. It may take time for us to see what's happening. So we don't know whether this is going to be bullish or bearish to the oil market. And obviously, many other things could happen. I mean, we're talking about here about the oil market and energy prices, but what happens in the Kremlin, there are thousands of lives at risk in Ukraine. I mean, this may end the war in Ukraine, or it may just even accelerate and increase the level of fighting. I mean, we have seen some of the right-wing actors in Russia have been advocating for the use of nuclear weapons. So we don't really know what is going to happen.
Despite that uncertainty, though, obviously the seismic events over the weekend that we've all been gripped by now for days, what's changed seems to be that there is a realization now that Vladimir Putin is not invincible, that his reign in the Kremlin may now be coming to an end, or at least we can conceive of a Russia without Vladimir Putin at the head. What does that mean for the oil markets, and what sort of scenarios do you think are most likely, in your view, to play out over the coming years?
Well, one important thing, that this is a bit of a deja vu for the oil market. We have seen regime change having a significant importance on oil market. I was mentioning earlier, 1979, the Islamic Revolution in Iran and the fall of the Shah and the arrival of Ayatollah Khomeini. We saw it also in the late 90s, the elections in 1998, the presidency in 1999 of Hugo Chavez of Venezuela. Venezuela was weakening OPEC, was flooding the oil market, and all of a sudden, overnight, the regime changed in Venezuela, and it went from being anti-OPEC and pro-low prices to be the most pro-OPEC country and the most hawkish oil country within OPEC, trying to advocate for high prices. So obviously the politics are going to have much of an importance. If I had to put, I'm not a betting man, but I have to put some money on the table, I will say that, to me, the scenario as you described, we have seen that Vladimir Putin is not all power, that he has weaknesses, and perhaps we can see him removed from within. And we know that a lot of people within the Kremlin establishment have a lot of doubts about the alliance with OPEC. Igor Sechin, the head of Rosneft, which surely will play a role in the shadows or whatever happens in the next few weeks in Russia, is completely against, he's publicly against the deal with Saudi Arabia. So I will say that perhaps the most likely scenario is, if Putin was to fall, is a situation that is bearish for the oil market, because it means that Russia walks away from OPEC.
But Javier, I'm quite intrigued by the relationship between Saudi Arabia, Russia, and China. So China, a huge consumer of oil, Saudi Arabia, of course, a huge producer, and both in different ways have been, if not supporting Russia, certainly not gone aggressively against the war in Ukraine. Who sells more to China at the moment? Is it Russia or Saudi Arabia?
Well, both are selling almost the same thing. And obviously, increasingly, Russia is selling more into India and China, markets that were previously basically the territory of Saudi Arabia. But let's not forget, yes, Saudi Arabia is losing market share in markets in Asia, but at the same time, it's winning market share in Europe. All of a sudden, Saudi Arabia is selling more oil in Europe than it used to be. Obviously, Europe is not the same as China in terms of growth. That's a declining, and probably a market that is going to be declining permanently, where China is where all the growth is. So I don't think that Saudi Arabia will be very happy to give away a lot of market share into China. But for now, when we are looking at market shares and the battle for market share, what I will say is Saudi Arabia is losing somewhere, but is gaining market share somewhere else. So I don't think that at the moment they are suffering much from Russia.
Saudi Arabia also, of course, cutting production unilaterally. They have cut production in the past, and everyone's saying, you know, you're putting the world economy at risk. And actually, they've been right so far that prices held up because of maybe weakness in the economy. Would they have called Vladimir Putin over the weekend to figure out the situation? Who has to lose more from an unstable Russia?
I would think that Saudi Arabia is like the rest of the oil market on a wait-and-see situation. Probably is using its embassy in Moscow to try to gather information. Probably they are asking questions to people in the Ministry of Energy and the Office of the Deputy Prime Minister of Russia, which has the communications with OPEC. But I don't think that they're going to take a very active role. I mean, they are, and this is important to realize, for Saudi Arabia, this alliance with Russia, particularly during the war, is about business. It's about keeping the oil market at a certain level, the oil prices at a certain level. I don't think that they are with Putin for what Putin is trying to do and has done in Ukraine. However, obviously separating what is politics from business, from human rights, I don't think that you could separate them. But the Saudis will be also on a wait-and-see situation.
Javier, tell us all a bit about the conversations you're having with policymakers. Until this huge news story broke over the weekend, the narrative around central banking was how inflation was running out of control. We had the Bank of England surprising markets with a very large increase in rates last week, a 50 basis point increase, and the narrative here that the bank has slightly lost control of that situation. How are policymakers absorbing the news over the weekend, and how is it changing that story of inflation that has been such a problem up to now, and that central banks are being criticized around the world for not bringing under control? How are they talking about things differently after the weekend's events?
I think that for now, the events in Russia are not really factoring yet on a change on inflation forecasting by central banks. My sense is that they are also in a wait-and-see situation, because the range of outcomes that we can have from Russia are massive. As I said, I can paint a very bullish scenario and an extremely bearish scenario, all with more or less Vladimir Putin leaving Russia. So I don't think that they are yet there in terms of the debate from policymakers. What I have been hearing here is from the public debates and the speeches that policymakers have been given is a lot of concern about how energy inflation continues to pass through, particularly in the service sector. A lot of concerns about the fact that, yes, perhaps prices have stopped going up. In the case of oil, has come down. But looking in particular at our electricity prices, they came down. But for retail prices, they remain double what they used to be. And consumers, small and medium enterprises, are paying much higher prices than they used to be. And that's one of the reasons why we are seeing inflation in the service sector. There's a lot of focus at times on oil prices, but that in some ways is a bit of a 1973-79 view of the world economy. And today, electricity has a much bigger role. I was saying during my conference in Sintra, think about the meeting room where we were speaking. There was no use of oil, there was no use of gas, but we were using air conditioning probably, we were using audiovisual, we were using lights. All of that is electricity. And sometimes we obsess with the price of oil and we don't look at the price of electricity, which has a lot of importance.
What is your outlook then for electricity, Javier, over the coming months? I mean, do you see it coming down to more normal levels, or is inflation really baked into the price of electricity for the rest of the year?
I think that we see wholesale prices stabilizing at current levels, much lower than we saw at the end of last year, but about double what we used to consider a normal price for electricity before the crisis started. And that means that businesses in particular need to adjust to a cost of production that is double what it used to be. And that could be a business like, your hairdresser around the corner, which runs everything on the shop on electricity, or could be a big aluminium producer that smelts aluminium with also consumption of electricity. We have to get used to the fact that energy prices are not coming back to pre-crisis levels and that we are all a bit poorer.
So who needs to realize that? If you look at some of the structural changes, right? And this is not oil, this is electricity and others. First of all, do we need to reform the market in Europe? Which they're trying to, but frankly, it's very slow. And so how will we live in 5 years?
Well, I think that if I take a takeaway of what I have been hearing here at Sintra, the ECB summer retreat, is either, and when I say we, I mean society, companies and workers, either we assume that a bit poorer and we cannot continue pressing to recover that money that we don't have anymore, whether it is by profit margin by companies or wages by workers. Either that happens and we kind of tone it down, or the message I'm hearing from everyone on the central banking community is we'll do whatever it takes to kill inflation. And I think that they are very serious about whatever it takes. And whatever it takes is, if we need to engineer a recession, we will do it.
Yeah, we had Bloomberg Economics have put out a report this week, Javier, saying that they now predict a UK recession on the back of these aggressive rate hikes by the Bank of England. Do you see that as a Europe-wide or even a global phenomenon as the year pans out?
I will think that is a Europe-wide, the UK, Eurozone. Those are also the weaker economies. The US seems to be doing a bit better in terms of economic growth. But, let's not forget Q4 was negative growth in the Eurozone. Q1 was also negative growth, just barely negative, but enough to tilt us into a technical recession. Economic growth is perhaps a bit brighter in the UK, but not a lot. And certainly when one starts to factor current interest rates onto people, households, that need to renew mortgages, businesses that they have loans and they need to reprice those loans, it's going to be very painful next year.
Javier, what's crazier in how we set energy prices? The system is different in the UK than Europe. What needs to be reformed more urgently? For example, in the UK, energy bills are set to stay high despite the price cap cut.
I mean, every country in Europe have a different system. Taxation plays a big role. I mean, of what retail, consumers, households, you and myself, David, we pay probably a quarter is taxes. It varies on different countries. It's good that consumers get longer term contracts because it gives them some time to prepare and it just kind of mitigates the big fluctuations of the market. As you see mine, and last year we saw absolutely extraordinary, sky high, eye-watering, you call it whatever, crazy prices on the wholesale power market in the UK. I would not want, as a consumer, to have to pay those. I prefer to have a 3-month or a 6-month average contract that is going to smooth out things. It's the same thing in many other European countries. Obviously, the reverse is also true. When prices start to drop, it takes time for us to benefit from those prices. But what is important to me is prices, even they have fallen, they have not gone back all the way to pre-crisis level. We are staying around 100 euros, 100 pounds per megawatt hour for electricity prices. When pre-crisis, a price of 40 to 50 was already considered high. We are still double. Yes, we are not at 500 that we reach out at some point. So prices have come down, but we are not back to 2019, and I don't think that that's going to happen.
But if you look at the inflation complex at the moment, energy prices are actually not the bulk of it. So is it just an excuse? We started talking about...
I think that energy prices continue to pass through. I mean, there's some businesses in particular have reacted to all of these price increases, and they are trying to protect their margins. And it was an expectation, and this is also very important about the return to normal. When I was speaking to CEOs at the beginning of the crisis, say around late 2021, beginning of 2022, and certainly around March when Russia invades Ukraine, a lot of CEOs, particularly of industrial companies, were preparing for 6 weeks of pain. Then it turned out that they were preparing for 6 months of pain. And now they're preparing for a structural increase in energy prices, that we are not going back to the normal. And they are reacting, trying to protect their margins, because they are realizing now that we are not going back to the normal. And also, as the price of everything is going up, it's only normal that workers are trying also to protect their margins. It's called salaries. And that is where the central banks are getting very worried, because if everyone tries to protect their margin, whether it's profit margins or salaries, then inflation will become entrenched. And that's what, the warnings I've been hearing here in Sintra, very public comments, particularly by ECB leader Christine Lagarde, has been whatever it takes to defeat inflation.
Yeah, we're used, aren't we, Javier, to hearing policymakers, governments cite the war in Ukraine as the reason why we have to tolerate higher energy prices, why inflation is where it is. But, as you've laid out, perhaps a scenario that unfolds in the coming months is maybe we're seeing the beginning of the end of that conflict. When it's going away, what I'm hearing from you is that is not going to fix the inflation problem. It is not going to fix the high energy problem. We've all got to get used to being that little bit poorer. Is the only solution to high inflation, high energy prices, the recession that policymakers seem willing to push us into?
Well, it is one of the solutions, quote unquote. That is always what kills inflation, is very weak economic growth. We can invest more in energy production. Unfortunately, at the moment, fortunately, the fossil fuel industry is investing just enough to meet Paris targets, just net zero by 2050. Demand for fossil fuels, however, is not going into that trajectory. The opposite is happening. It keeps increasing. This year, probably, we're going to see record oil demand, record gas demand, and most likely record coal demand in the year of 2023, 30 years after we beginning to get serious about climate change fighting. And the other solution is a massive increase in investment in green energy, and nuclear for sure. But that is also not coming nearly enough as is needed. So we are not investing enough on fossil fuels, and we are not investing enough in green energy. And that is creating a crunch. That is also what is keeping prices higher than usual. It's not just Ukraine.
And it's not the fault of central bankers, is it? The lack of investment in these infrastructures. It's the failings of governments and administrations around Europe and all around the world. Is there frustration amongst the policymakers you're talking to? Is this that side of the equation? They have no power over it.
I think there is a sense of frustration there. It was a very interesting comment by the head of the Bundesbank, which basically said I'm paraphrasing, but he went to say something like, we are very good at dealing with the effects of energy crisis, but we are not in the driving seat. We central banks control monetary policy, but these politicians, not just policymakers, but I would say politicians, heads of government, of state, who have to take the leadership here and say what is needed to resolve the energy crunch and put policies in place that could help to increase the supply of energy. But one point I will make, if previously it was difficult to invest in green technologies, green energy, when interest rates were close to 1%, the cost of capital was very low. So, even small returns on those investments, say 8%, was considered good money. With interest rates going up, that's going to make investing in green energy more difficult.
Javier, thank you so much.
Thank you.
Thanks for listening to this week's In the City. We will be back next week.
But in the meantime, if you like our show, please head on over to Apple Podcasts or wherever you listen to podcasts and rate, review and subscribe.
This episode was hosted by me, David Merritt.
And me, Francine Lacqua.
It was produced by Summer Sadi.
Additional editing by Blake Maples.
Special thanks to Javier Blas.